This video examines the fraud behind so-called high-yield standby letter of credit, or SBLC, private placement programs. We will break down how these fraudulent pitches function, why the claimed returns are economically impossible, and the significant risks involved for applicants and issuing banks. First, we must distinguish between three very different things: legitimate standby letters of credit, genuine private placement offerings, and fictitious trading programs. Securities regulators explicitly state that these so-called secret trading programs do not exist and are, in fact, scams. A legitimate standby letter of credit is a contingent bank undertaking that supports a payment or performance obligation. It is a tool for credit substitution, not a liquid investment. The process relies on strict documentary requirements and international standards. Fraud promoters often claim exclusive access to secret platforms, promising high returns with no risk. However, regulators consistently warn that these claims, including the supposed monetization of SBLCs or the use of specific SWIFT messages as proof of authenticity, are common indicators of financial fraud. Regulators and law enforcement agencies are clear. The SEC and FBI warn that programs claiming to offer disproportionate returns without risk are fraudulent. These conclusions are based on established facts, not mere market opinion. The returns promised by these programs are economically absurd. Claiming to turn a $1 million investment into millions through compounding high-yield returns violates basic economic principles. If such returns were truly possible and risk-free, the promoters would not need to solicit outside investors. Language used by promoters, such as risk-free, bank-to-bank, or trader-only access, is a significant red flag. Legitimate investments always carry risk, and complexity is never a substitute for verifiable proof from an authorized banking institution. Issuing banks face real exposure when issuing a standby letter of credit. They must honor complying draws regardless of the underlying commercial situation. Because the bank is primarily liable to the beneficiary, they must evaluate the applicant's ability to reimburse them with the same rigor as a loan. Applicants can remain liable even after value is allegedly extracted. Legal frameworks governing standby letters of credit mean that victims may lose control of rights while remaining fully responsible to the bank, often facing further fees and legal costs. Specific message types like MT760 or MT799 are standard banking communication tools. They do not create or validate a secret trading program. The authenticity of a transaction must be verified through official, independent bank channels, not by the labels on a message. Past Department of Justice cases demonstrate how these schemes operate, often involving large upfront deposits for non-existent programs. Defendants in these cases have faced significant prison sentences, proving the serious legal consequences of participating in such arrangements. Distinguish between professional service fees and suspicious demands. Legitimate retainers involve clear agreements and transparent billing. Conversely, pressure to pay fees to, quote, unlock or activate funds is a hallmark of advance fee fraud. Due diligence is essential. Always identify all parties, verify independently through official banking channels, and consult with independent legal or finance counsel. If a promoter refuses independent verification or cannot explain the lawful source of profit, stop immediately. If you believe a program is fraudulent, cease all activity immediately and preserve all records. Report the pitch to appropriate authorities, such as the FBI's Internet Crime Complaint Center or the SEC, and engage independent counsel for guidance. In conclusion, a legitimate standby letter of credit is a contingent bank obligation, not a secret, high-yield investment vehicle. Always verify the transaction through official channels before creating any financial exposure.